Greetings. In this video, I'm going to be taking a second look at Paul Gabriel's short on Nvidia, the host of the Everything Money Value Investing channel. Although I have been unable to identify the precise time that Mr. Gabriel initiated his short, evidence indicates that it occurred sometime in the first or second quarter of 2023. I suspect, on the basis of available yet incomplete evidence, that Mr. Gabriel was selling naked leap calls, dealing deeply out of the money short calls, collecting a premium up front, and in exchange, pledging to deliver the 100 shares times the number of contracts he dealt to the party on the other side of the contract at the predetermined strike price if the call options were exercised, thereby making his potential losses virtually infinite, since there's no limit on how high share prices can rise and his profit is limited to the premium he received. The stock hypothetically trading at 5, 50, 80, 99% or anything below 1.0 of the strike price at the expiration date would, as a consequence, not change his cap profits, just the premium he received he would have. So if that was indeed a strategy, he was essentially betting that the odds that Nvidia shares would violently climb upward were overstated in the options market. I have reached this conclusion on the basis of incomplete evidence. It is possible that he could have done a bear call spread, but if he bought calls with a strike price of say 390 or 380 to hedge, he would have been partially protected as it surged past 380 to 390. If we suppose it was naked calls he sold when the stock was trading around, say, 275, I mean, the stock had rallied violently before this video was made. So with the strike price between 380 and 390, perhaps thinking he was just going to collect this easy premium from a sucker, since in his mind, the stock was almost certainly not going to climb above that 380 to 390 range. Since if he did, in fact, deal those options, they were deeply out of the money, the premiums he received would be relatively small and his losses would be enormous as the stock climbed above the strike price. Hence, his "I want everybody to pray for me because tomorrow's going to be a rough day" quote. End of quote. That remark strongly signals asymmetric uncapped downside. Selling options on a highly volatile asset, obviously naked options on a highly volatile asset, obviously flirts with a dangerous tail risk exposure without any structural backstop. I'm not necessarily against this strategy. Perhaps it makes sense in certain cases, but it's obviously something that is to be taken with extreme caution and should only be used if you actually know what you're doing. If he had executed a defined risk strategy, such as a bear call credit spread, in which he buys a higher strike call to cap the losses, his maximum downside would have been limited and known ahead of time in the worst case scenario for his trade. Perhaps the most robust piece of evidence supporting my hypothesis that it was indeed naked calls is his quote, which states, quote, "I shorted Nvidia with options, which means even." The word even indicates that the Nvidia shares declined substantially since he initiated the trade he's talking about. If Nvidia stays at 340, I could still make money because my bets are if they go like 380, 390 or higher, then I start losing money overall. Assuming what he said was truthful, the fact that he would have made money if the stock traded sideways indicates he held a positive theta position. He likely collected a premium up front and needed the stock to simply stay below his predetermined strike price so the contracts would expire worthless and he could just pocket the premiums he received as profit. Furthermore, his break-even point in the 380 to 390 range means the strike prices were deeply out of the money relative to the price at the time he placed the trade, if he did, in fact, sell those naked calls. I don't really think he did puts or regular puts because obviously, if he just did regular puts, then his downside would be capped to that premium, and he wouldn't be worried if the stock started climbing exponentially because he would just have those worthless options or they would expire worthless, whatever, right? You take cut your losses. your downside is capped strictly. So with the naked calls, obviously, you don't have that capped downside. As anyone can easily verify based on stock prices, Nvidia's rise was not easily predictable. I certainly wasn't shrewd enough to predict it myself. However, after considering relevant information pertaining to this case, I have struggled to find much strong evidence contradicting the hypothesis that Mr. Gabriel was going short Nvidia despite a lack of rigorous, robust, and forensic analysis. Evidence indicates that Mr. Gabriel believed his underlying thesis was correct, and he just got unlucky with bad timing due to market euphoria and irrationality. He was implying that it was one of those scenarios Keynes had in mind when he famously said, "The market can stay irrational longer than you could stay solvent." End of quote. In fact, that remark from Mr. Keynes was actually shown on the screen in his video titled, "I Lost Millions, So You Don't Have to." In that video, released on March 20th, 2024, Mr. Gabriel stated, quote, "I remember thinking to myself, the second I exit this, the market's just going to plummet." It did not. It just proves that markets can be irrational longer than I can stay solvent. I did lose money, about 10 or 20% of my net worth. That's why I like to diversify my investments. This quotation illustrates that Mr. Gabriel still believed his underlying thesis was correct and that he just got unlucky due to market irrationality. Of course, Nvidia's future cash flows ultimately justified its, at the time, stock price and then some. And the capital markets rationally and ruthlessly exposed that fact. As subsequent data of Nvidia's fundamentals demonstrated, investors were very much rational to bid up the price of Nvidia's shares, and Paul fundamentally wildly misjudged Nvidia's prospects for future cash flows. Perhaps a telling quotation comes from a video titled, uh, I don't have the title of this video right now, but he proclaimed, I'll leave it in the description of this video so you could check it out there. And in this video, Mr. Gabriel says the price to sales ratio has fallen to 34 because they, Nvidia, crush their revenue so much. One of our users on YouTube wrote, if you base it on next year's numbers, their price to sales ratio is 15, not 47. Paul Gabriel said that Mr. Gabriel, the one host of Everything Money, said, fair enough, and he has a valid point, but 15 is still expensive. Microsoft, which I think is overpriced, still is selling for 11.3. So 15 for Nvidia is still high, and the difference in Microsoft's gross margin is 69%. Nvidia just reported 70% gross margin this last quarter, but before then it was in the 40s. Apple's price to sales ratio is 7.3, so even at 15, Nvidia is double Apple's, roughly double. And I'm not buying Apple at 179 in a quote. Instead of speculating on what Nvidia's future margins will be, Mr. Gabriel pointed out a historical fact about what Nvidia's past gross margins were. Obviously, past profit margins for a firm per se have no bearing on its future margins, which are only things that matter, or which are the only things that matter. It's going to be the future that matters in terms of, well, what is the present value of this business? Mr. Gabriel subsequently contended that, quote, so these are things to consider. And I find that when things are overpriced, people start to look in the future more and more. Like, well, yeah, but if you take this next year's or 2 years from now revenue or profit, it's pretty reasonable. You know, he's quoting someone else saying, but if you take next year's or 2 years profit from now, it looks pretty reasonable. And Paul says, yeah, but they still, or Mr. Gabriel says, yeah, they still have to earn that. Don't pay them today for what they're going to do in the future, he says, right? You can to a certain level, but you still have to be conservative. You have to have a margin of safety and make sure that the company can actually hit those targets. Okay. That's a big thing there. So he says, don't pay for them. I'll repeat this. Don't pay them today for what they're going to do in the future. End of quote. That was obviously a rather dubious and bemusing remark. For all that matters for capital assets and means of production, at least in terms of their economic value, is the future. Thankfully, he goes back on his statement to some extent by saying you can to a certain level, but you have to be conservative. End of quote. To a certain level, the future is all that matters. It's the only thing that matters. Everything, even financial statements, are only useful insofar that they assist you in more accurately forecasting future cash flows and interest rates. The future matters to the utmost extent. Moreover, there is no way to know for certain the future cash flows of an asset or what they will generate over time because those cash flows are in the future and the future is uncertain. Your job is to speculate about what those future cash flows are and discount their present value based on your speculative guess of future interest rates. The essence of the entrepreneurial speculator is one who identifies an asset or undervalued or over that's overvalued or undervalued based on their speculations about the future, which occur at a certain moment in time, and then short or go long as a result. The entire idea is to make speculations about the future at a certain point in time and foresee things before your peers catch on. To buy where and when things are cheap and sell where and where things are dear. Mr. Gabriel shorted a fundamentally undervalued stock. Mr. Gabriel put 20, 30, and 40% profit margins into his stock analyzer tool, low, middle, and high, and subsequently attempted to justify it when he said, Nvidia hasn't, quote, Nvidia hasn't even beaten a 30% profit or free cash flow margin over a 5 or 10 year period in the last 10 years. So assigning 40% on the high side is very generous. It appears that Mr. Paul is overly concerned with the past as a guide for forecasting the future. Okay, this is the 10-year average, therefore it's generous to put this. Of course, the world isn't static. We don't live in the evenly rotating economy. There's change, unforeseen change. So um, there's the idea that the profit margins are going to be similar or the same as they are in the past is there needs to be evidence for that. Why is that going to be the case? It doesn't have to be the case, obviously. Okay, so it appears he's very or overly concerned with the past as a guide to forecasting the future. He did not get unlucky with his Nvidia short. His thesis was simply fallacious. Shorting an overvalued asset is a perfectly decent strategy, albeit with its own risks, if the asset is actually overvalued. I shall provide evidence that no forensic analysis was conducted and that new relevant data was overlooked. The following is a quote from a video released on August 23rd, 2023. Quote, Nvidia stock is up 6%, so it makes this 47 times revenue. If your next door neighbor has a flower shop that makes $1 million a year in revenue and has a lot of potential, would you pay $47 million for it? I don't care what it makes. I don't care if it's half profit. That's 94 times profit, guys. This is a tough one for me. And I know in the short run, I look really stupid here. He had just admitted he was short and is down heavy on it. I get it. Lay it on right now. I'm not going to fight that. Lay it on. But remember, we said the same thing about Tesla when it was 404 or 414. And look at it now, it's 250. And we think it has a lot more to go down. This is a very hyped up market. Comparing that, end of quote, comparing that to the producer of comparing that flower shop, for your neighbor's local flower shop, to the producer of the finest graphics processing units on the planet, an essential ingredient for large language models, autonomous vehicles, autonomous machinery, cloud computing software and infrastructure, much of the modern world, to a random neighbor's flower shop, perhaps indicates a profound lack of understanding of why the corporation's stock was trading at such a high multiple and why its profit was growing so rapidly. Paul then boldly went on, "Oh, quote, oh, what's up? Are they buying back shares? Oh, Lord, oh, my Lord. They returned $3.38 billion to shareholders through the repurchase of 7.5 million shares. I'm going to say this. The only thing dumber than Nvidia's valuation is buying back shares if you're an owner of the company. And on Monday, they approved an additional $25 billion. They are taking money and pissing it down the toilet. He adamantly, Mr. Gabriel adamantly and confidently contended. They are investing the money at 47 times. The thing's up 9%. Mo is his co-host. 513 a share. Nvidia's management evidently correctly believed that its common stock was underpriced. And since they were entirely correct, those share repurchases have greatly amplified existing returns for shareholders. Instead of considering that he might have actually been wrong, consider why management, with the vast amount of information about their business and its trajectory, was repurchasing shares. He defaulted to insulting them for a decision that turned out to be massively accretive to shareholder returns. He then input profit margins of 20, 30, and 40% for his low, middle, and high for a different video again. So he inputted that into his DCF model, even though Nvidia has just reported profit margins, or had just in that time period just reported profit margins of 46% in the last quarter. And Mr. Gabriel implied that they were overly optimistic assumptions when he subsequently said, referring to those assumptions, okay, this is nuts. Moreover, in a subsequent video titled, "Holy cow, Nvidia stock is soaring right now. Here's why." On May 22nd, 2024, Mr. Gabriel set a 40% margin as his middle assumption for Nvidia and called his assumptions absurd and, quote, aggressive as hell, implying they were wildly optimistic and unrealistic. One could reasonably conclude that the evidence suggesting that Mr. Gabriel did not deeply understand what he was shorting is robust. In a video on Nvidia published on August 18th of 2023, Mr. Gabriel and his co-host appeared underwhelmed and surprised by Nvidia's lack of reported free cash flow, as Mr. Gabriel stated. Now, 5-year average free cash flow and last year's free cash flow, that kind of surprises me. They're pretty much the same thing. For a company that's supposed to be killing it, how is the 5-year average free cash flow the same as the 1-year their 1-year free cash flow? Mr. Gabriel's co-host contending, quote, "Now this is a good thing to point out, though. For a company that's supposed to be killing it, the story is killing it." End of quote. Perhaps Mr. Gabriel simply zoned out while he was reading the company's financial disclosures, which explained why reported free cash flow was temporarily suppressed. Screeners pull top-line numbers without providing the context behind why those numbers shifted. Nvidia's primary accounting reports suggested that the free cash flow drop was largely not a deterioration of their core business, but rather the result of massive one-off charges and strategic supply chain prepayments designed to secure future AI chip capacity. Nvidia's fiscal 2023 net cash provided by operating activities fell to 5.64 billion, which was down from 9.11 billion in fiscal 2022, and its free cash flow dropped by roughly 53%. That decline was driven by three primary factors. One was one-time accounting charges. Nvidia's net income fell by 55% to 4.37 billion, which was partially because of a $1.35 billion write-off resulting from the termination of the ARM acquisition. Additionally, a sudden drop in gaming demand resulted in a $1.34 billion charge related to inventory and warranty reserves. Strategic prepayments and inventory buildup were also a huge factor. To secure manufacturing capacity for future data center GPUs like the H100, amidst global supply chain shortages, Nvidia locked in long-term supply agreements, and they paid 3.14 billion prepaid ahead of time. So 3.14 billion cash gone. Increased capex. Free cash flow was further reduced by increased capital investments on internal computing infrastructure to support research and development. Because cash flow statements track the actual cash entering and leaving the business, those massive prepayments and one-off penalties drain cash in the short term, heavily skewing the one-year trailing metrics on the stock screener. Now, I shall provide evidence supporting these three things from Nvidia's financial statements, a review of Nvidia's fiscal 2023 earnings reports, and also CFO commentary provides verbatim explanations for the cash flow dips. On the ARM acquisition penalty in Q1 of fiscal year 2023. GAAP operating expenses include, quote, GAAP operating expenses include a $1.35 billion acquisition termination charge related to the ARM transaction, end of quote. Cash flow from operating activities was $1.73 billion, down from $1.87 billion a year ago and down from $3.03 billion a quarter ago. These decreases primarily reflect advanced payments on supply agreements, end of quote. On the inventory write-downs, Q2 of fiscal year 2023, GAAP and non-GAAP gross margin decreases, quote, GAAP and non-GAAP gross margin decreases were primarily due to a $1.34 billion charge comprised of $1.22 billion for inventory and related cash reserves and $122 million for warranty reserves. Okay, so end of quote. On the prepayments and inventory of Q3 of fiscal year 2023, let's say, quote, the year-on-year increase in operating cash flow reflects lower operating income, timing of supplier payments and inventory deliveries. Inventory increased sequentially, primarily driven by a new data center and gaming architecture supply. Prepaid supply agreements for $3.14 billion, end of quote. While treating these three as equivalent temporary suppressors of free cash flow is a mild oversimplification, since the gaming inventory issue was a real business problem, not just an accounting artifact, the point stands. One would think that if you are taking a short position and have access to a large audience, you should perhaps supply them with a simple thesis on what others are missing to facilitate rapid price discovery. For instance, why is the demand for Nvidia's chips going to be far lower than investors expect? Why is it reasonable to assume that Nvidia's profit margins will average 30%? Those are your middle assumptions when they just printed roughly 46% in their most recent quarter. And one could go on. What are all these bear cases that you have? Why is it that it's reasonable to conclude that, yeah, Nvidia is overvalued and we should short Nvidia? Spreading that information to market participants allows for more rapid price discovery, and we don't get as many speculative manias. That's what the short seller is there for, to identify that overvalued asset and profit from exposing that. From what I could find, the evidence indicates that Mr. Gabriel lacked a cogent thesis, some fundamental truth investors were overlooking that he discovered through forensic analysis, through forensic research on the corporation. Consistently earning super marginal profits from trading derivatives, where the underlying asset has as large a market capitalization as Nvidia, or something like Nvidia, which are not broadly diversified indexes, is not particularly easy to do and generally requires incredibly rigorous research, financial literacy, deep industry knowledge, educated guesses about the future, and a sound process. So one would think one would conduct extremely rigorous research before initiating a short position, especially if he did, in fact, do that naked call strategy with the downside unlimited. Perhaps this is why Mr. Gabriel generally opts for a diversified investment strategy, which, as the investor Warren Buffett has once contended, is a perfectly sound strategy to protect against one's own ignorance. In a video uploaded on June 22nd, 2026, Mr. Gabriel indicated owning 21 different stocks across a vast number of sectors, including fintech, asset management, retail, restaurants, software and hardware, e-commerce, media, airlines, tobacco, and electrical equipment. Perhaps Mr. Gabriel really has an informational edge against all of those for all of those securities and has deep knowledge in all those industries, but it is difficult to conclude that this is likely. Mr. Gabriel also once said, if you have a good process for investing and you keep doing the basic things over and over, you will do very well. End of quote. But perhaps one is left asking themselves, how well has Mr. Gabriel done? The investor seems to take pride in transparency, so perhaps he is willing to share a brokerage statement that tracked his performance over the years. I said leap calls in the beginning of this article, or suggested that that could have been the case, or because he said, quote, I am short Nvidia. I am down a lot of money. I am okay with it because my short goes until June or December of 2025. And I just feel like this is a company that's been a lot of hype. Sick. Okay. End of quote. So, those are that. So basically, he said that in let's see, August of 2023, and it looks like he had the expiration date all the way in June or December of 2025. June or December, perhaps he was doing uh some option. He was writing some options, selling them with an expiration date expire somewhere in June of 2025, and some with December of 2025. And perhaps he was just doing that with a few different ones. Um, it's not. I'm not sure. It's still not clear what his method of shorting was. He said options in particular in one of the videos. So naked calls seems like the most likely one of all of them based on the information available to us, but I can't definitively determine what his strategy was for shorting Nvidia. Regardless, the sources will be in the description below, and I thank you all for listening. Have a good one.